Why the UK housing market isn't telling the whole story? Every week there seems to be a new prediction about the UK property market. Some experts are convinced prices are heading for another major rally. Others warn that a downturn is just around the corner. But instead of relying on options, let's focus on the latest official statistics and see what they actually reveal. We will start with the national overview before breaking the numbers down by region. Once you compare the different parts of the country, a fascinating pattern begins to emerge. It could represent a significant shift in how the UK housing market behaves. We will also look beyond property values and examine what's happening with rental prices. Understanding both markets is essential if you want to see the complete picture. Most headlines are currently celebrating one statistic. The average UK home is now worth around 271,000 British pounds. That represents annual growth of approximately 2.5%. At first glance, that sounds encouraging. However, there's an important detail hiding inside the methodology. The Office for National Statistics has acknowledged that it's revising how it values newly built homes. Officials believe previous calculations may have slightly overstated prices in this segment of the market. Since new build purchases represent only a relatively small proportion of total transactions, the impact on nationwide figures should be limited. Nevertheless, it reminds us that measuring millions of homes across the country is far from straightforward. Property is unlike most other assets. Every home is unique. Transactions happen at different times. Local conditions vary dramatically. Producing a single national average is therefore much more complicated than many people realize. If we step back and view price movements over the last decade, today's market looks surprisingly calm. After the extraordinary surge that followed the temporary stamp duty reductions during the pandemic, annual growth has returned to much more modest levels. Compared with the rapid increases seen during that period, today's numbers appear relatively restrained. But there's another figure that deserves even more attention than house price growth itself: inflation. This is where many discussions about property become misleading. Imagine leaving £100,000 sitting in an account that earns no interest. Prices across the economy rise by 10% over the year. Your balance hasn't changed, but what that money can actually buy has fallen significantly. Property works in a similar way. Owning a home isn't just about the number attached to it. It's also about what that value represents in terms of purchasing power. If property prices increase more slowly than inflation, homeowners may appear wealthier on paper, but in real economic terms, their housing wealth has lost value. That's exactly what we are seeing today. Nominal house prices have increased by roughly 2.5%. CPIH inflation, which includes housing-related costs, has been running closer to 3.6%. In other words, the value of housing has not kept pace with the rising cost of living. When economists adjust property values for inflation, the picture changes dramatically. Instead of seeing a steadily rising market, inflation-adjusted charts reveal that today's real house values are much lower than the peaks reached before the global financial crisis. Viewed through this lens, current prices are much closer to levels seen more than a decade ago. Looking back over the last 10 years makes the trend even clearer. The pandemic created an exceptional spike in real property values. It was driven by historically low borrowing costs, tax incentives, and changing lifestyle priorities. Since then, much of that inflation-adjusted gains has gradually disappeared. This often confuses homeowners. Many people naturally think that if their property is worth more pounds today than it was last year, they must be richer. Technically, that's true in nominal terms, but if everyday goods, services, and living costs have risen even faster, then the real spending power of that housing wealth has actually declined. Some economists describe this as a silent correction. Unlike an outright price crash, homeowners rarely feel the impact immediately. That's because the headline number attached to their home continues to rise. Politically, this type of adjustment is far less controversial than falling house prices, yet it may quietly improve conditions for buyers trying to enter the market. The reason is simple. If wages grow faster than both inflation and house prices, prospective buyers gradually become better positioned to afford a home. Recent earnings data suggests this may finally be starting to happen. For many years following the 2008 financial crisis, pay increases consistently failed to keep up with inflation. Workers found themselves earning more pounds while becoming poorer in real terms. The situation became even worse during the inflation surge that followed the pandemic. Living costs accelerated much faster than salaries. Most recently, however, average earnings have begun to outperform inflation. That represents an important shift. Of course, national averages never reflect everyone's experience. Many households have not received wage increase anywhere near these figures. Others have seen much stronger income growth. Average statistics can easily hide enormous differences between industries, age groups, and regions. Nevertheless, when viewed across the country as a whole, incomes have recently been rising faster than both inflation and house prices. That combination improves affordability compared with just a few years ago. This evidence appears in buyer activity as well. First-time purchasers now account for one of the largest shares of housing transactions seen in roughly a decade. Another encouraging sign comes from the price-to-income ratio. Compared with the recent years, the average first-time buyer now needs a smaller multiple of the annual salary to purchase a home. Although affordability remains stretched in many locations, particularly in London, the national trend has become noticeably less extreme than it was during the post-pandemic boom. Mortgage payments are also consuming a smaller portion of first-time buyers' incomes than they did when interest rates peaked. The market is still far more easy. Buying a home remains a major financial challenge for millions of people. But compared with the conditions buyers faced only a short time ago, several of the key affordability indicators have started moving in a more favorable direction. The question now is whether this improvement will continue, or whether regional differences will create a completely different story once we zoom in beyond the national average. Although first-time buyers are still spending a larger share of their income on housing than the long-term average, conditions have improved compared with recent years. Mortgage repayments now consume roughly one-third of a typical buyer's income, far below some of the most challenging periods in UK housing history. For perspective, during the late 1980s, many homeowners were committing close to half of their take-home pay to mortgage repayments. Today's situation isn't easy, but historically it has recently been worse. That raises an obvious question. If affordability indicators are moving in the right direction, why do so many people still feel completely locked out of the market? The biggest obstacle isn't necessarily the monthly payment. It's getting through the front door in the first place. The average UK property now requires a deposit of around £27,000 if a buyer is putting down 10%. For someone at the beginning of their career, building savings on that scale can take many years of disciplined budgeting. Imagine setting aside several £100s every month while also paying rent, covering everyday living costs, and hoping property prices don't rise faster than your saving account. That's the challenge facing thousands of aspiring homeowners. Ironically, many of those buyers could comfortably manage the monthly mortgage once they own the property. In numerous parts of the country, mortgages repayments would actually be similar or even lower than the rent they are already paying. The real barrier is accumulating enough cash before lenders will approve the loan. This is one reason family support has become increasingly important. A significant proportion of first-time buyers receive financial assistance through gifts, loans, or inherited wealth, making family circumstances an increasingly important factor in home ownership. That naturally raises an important policy question. Is there a better way to help responsible buyers overcome the deposit handle without simply inflating house prices further? One possible idea worth discussing is whether the long-term possession saving could play a limited role earlier in life. Rather than withdrawing retirement funds outright, perhaps buyers could use part of their pension as additional security when applying for a mortgage, reducing the deposit required while protecting the long-term value of those retirement savings. Any proposal like this would require careful design. It would need to avoid excessive fees, prevent people from damaging their future retirement income, and ensure lenders weren't taking on unreasonable risk. There's also the possibility that increasing purchasing power would simply push house prices even higher, cancelling out much of the intended benefit. Even so, exploring fresh ideas may be necessary because existing schemes haven't fully solved the problem. An added advantage could be that younger workers become much more engaged with pension savings if they see it providing a particular benefit decades before retirement. Instead of viewing pension as money they will never access, they might see them as part of their journey towards buying a first home. Whether that's the right solution is open to debate, but it's clear the deposit issue remains one of the biggest challenges facing new buyers. Now let's shift our attention to the rental market. Average private rents across the UK continued to rise over the past year, although the pace of growth has begun to slow slightly. While rental inflation remains significant, it isn't accelerating as quickly as it was previously. However, legislation coming into force this year could have a much greater impact than the latest percentage increase. The new rental reforms aim to standardize how landlords increase rent. Instead of introducing large or unexpected rent hikes, landlords will generally be limited to one increase per year based on the property's current market value. Tenants who believe an increase exceeds a fair market rate will have the right to challenge that decision through an independent tribunal. In theory, this should reduce situations where excessive rent increases are used to pressure tenants into leaving. The effectiveness of the reforms, however, will depend heavily on how efficiently disputes are handled. If tribunal hearings take months to resolve, both landlords and tenants could find themselves stuck in lengthy periods of uncertainty. Creating new legal rights is one thing, ensuring the system has enough capacity to enforce those rights is something entirely different. Even so, simply knowing that these protections exist may encourage more balanced negotiations between landlords and tenants. When we move beyond the national averages, the rental market becomes more interesting. Different parts of the UK are experiencing very different levels of rental growth. England, Wales, Scotland and Northern Ireland each tell their own story, with some markets recording considerably faster increases than others. This demonstrates why relying solely on UK-wide averages can be misleading. Someone renting in Wales faces a completely different market from someone searching for accommodation in London. Regional data paints a much clearer picture. Within England itself, the contrast becomes even more striking. Northern regions continue to experiencing some of the strongest rental growth, while London has recorded one of the weakest rates of increase. That represents a remarkable change compared with the trends that dominated the housing market for decades. The same shift can also be seen in house prices. London currently stands out as one of the few areas where annual price growth has has turned negative, while regions such as the Northeast and Northwest continue to record stronger performance. Once inflation is taken into account, the divide becomes even clearer. Only certain northern regions are currently delivering meaningful real growth in property values. This may be one of the most significant developments in today's housing market. For years, the assumption was simple: London would outperform the rest of the country, with other regions eventually following its lead. That relationship appears to be changing. Rather than viewing this as a collapse of southern England, it may be more accurate to describe it as a period of rebalancing. Recent data even suggests that London's slowdown has begun to stabilize, while some southern regions have already returned to modest growth. The adjustment appears gradually rather than dramatic. Nevertheless, affordability remains a major factor. High purchase prices and relatively weaker investment returns make many parts of London less attractive than they once were. Meanwhile, northern cities continue to offer lower entry prices alongside stronger rental yields and growing employment opportunities. Cities such as Greater Manchester illustrate this shift particularly well. Combined with the continued popularity of hybrid and remote working, people are no longer tied to London in the same way previous generations were. Businesses, skilled workers, and investments are becoming more geographically diverse. That broader redistribution of economic activity is gradually changing the housing market itself. Interestingly, many of the regions that remain among the UK's most affordable places to buy or rent are also recording some of the strongest percentage increases. Lower starting prices naturally create more room for future growth. Despite all these national and regional trends, there's one final point that's easy to overlook. Property is ultimately a local market. Statistics covering an entire region can never capture what's happening on individual streets. Two neighborhoods separated by only a few hundred meters can have completely different prices movements, buyer demand and investment potential. School catchment areas, transport links, regeneration projects, or even postcode boundaries can dramatically influence value. That's why anyone planning to buy, sell, or invest should pay far more attention to the immediate area they are interested in than to national averages. The numbers we have discussed provide valuable context, but the market that truly matters is the one surrounding the property you are actually considering. The latest data suggests that narrative may finally be evolving into something very different.